I'm Jesse Mackey, CIO of Forethought Financial Group, and this is Forethought's Market Perspective as of May 11th, 2021. Most broad stock indices are outperforming bonds by a wide margin so far this year. Also, U.S. small and mid-cap stocks have surged past our U.S. large cap and non-U.S. stock counterparts. Across all asset types, U.S. small caps are the best performers so far, while U.S. aggregate bonds show the worst year-to-date performance. Historical data indicates that once a new bull market has been confirmed, which happened on August 18th, when the S&P 500 index had recovered from its March 23, 2020 bear market low point and achieved a new record price, the shortest time period on record since 1950 before the beginning of another bear market was only 6 days, and the longest time on record was approximately 7.44 years, with the average coming in at 2.44 years. Approximately 8.87 months have elapsed from the point of bull confirmation in this instance so far. There's usually been at least one 10% plus correction, but often several, between most bear markets in history. The average time between the end of one correction or bear market and the start of another is a little over 1 year. The first correction in the current bull market was completed relatively early, about 7.63 months ago on September 24th. We like to refer to the combination of a correction and its corresponding recovery, which was registered on November 9th, as a wolf market. Our data set also tells us that about 55% of wolf markets like the last one we experienced have been followed by a period that exhibits trailing one-year returns of 30% or greater, something we refer to as an eagle market. The first eagle market subset of the current bull market was quantitatively confirmed on March 1st and has continued since then. In fact, just since the November 9th wolf market endpoint, the S&P 500 index has packed on additional gains of about 14.88% as of the close of business yesterday. Once an eagle market like this has been indicated, it continues for an average of an additional 5.35 months, although they sometimes end as quickly as the same day they're confirmed. Eagles may be followed by any of the other three market types, including a flattening of growth rates to return to a standard bull market, or an immediate reversion into a wolf or bear market. But given that stocks are still early in the traditional broader bull-bear market cycle by historical standards, an immediate bear market, although certainly possible, is the least likely of the various scenarios. Based on analysis of the complete historical market type data set using our multi-method adaptive algorithmic process, we're now allowing overweight allocations to opportunistic investing, neutral allocations to strategic asset allocation and liability-driven investing, and underweights to selective concentrated investing. From a probabilistic analysis perspective, valuations tell a story that's far more negative for stocks and more favorable for some pockets of the bond markets. On this basis, stock type valuations range from moderately to highly overvalued. Bond types range from moderately undervalued in the case of long-term U.S. Treasury bonds to moderately overvalued in the case of emerging markets bonds. Long-term U.S. Treasury bonds now reflect the most attractive pricing relative to the alternatives, while U.S. small and mid-cap stocks are the least attractive. Against this backdrop, the outlook for stocks is now neutral to negative in the intermediate term based on the overall aggregate of our historical market type data analysis and quantitative probabilistic analysis. I hope this was helpful. If you have questions, we'd like to discuss what this means for your particular situation, please contact Forethought at 516-300-1617 or at info@4tfg.com. And don't forget to subscribe to our blog feed and our YouTube channel. Thanks for watching, and see you next week.